Okay, let's play a game. Let's what? Let's play a game. Let's put this into practice. So Mike and Joe can hand out the first handout. So we're going to look at a company together. And I'm only going to give you some numbers. And what I want you to do is I want you to look at those numbers. And I want you to tell me what's going on with the company. Okay? As a group. So let's hand that out. Yeah, so everybody gets a copy. So taking what you've learned so far, okay? Taking what you've learned so far, and just look at the financial statement and look at what's going on. And I want you to get what's the story behind this company, what is going on, what's wrong, or what's good. What's good about the company too. Okay? What's good about the company, what's the story, what's bad about the company, what's happening. So do it as a group. Okay, let me give you, let's say, 10 minutes for that. Okay, go for it. No, you don't, right? No, accountant, don't get involved. No cheating, okay? Okay, okay, okay. Yeah, don't, just silence, mute. Okay, don't help them. In fact, if anything, mislead them a bit. Just like tell them. Yeah, don't say anything. Music? Awesome. Yeah, please. Give your neighbor a high five and say, we can do this. We can do this. Okay. Now. Okay. Okay. So how many of you agree this is a typical, financial statement, right? Balance sheet, income statement, density code. So now it's okay, to be honest. How many find this a little bit, look at numbers like, a little bit confusing? It's okay. Yeah, that's how we learn, yes? It's perfectly fine. It's not about right or wrong, it's about learning together. About what? Learning. That's okay, we'll work through this together. So you look at this, like, what does that mean? So looking at this, what could you tell me about this company? What's the story behind what's going on? Yes, Kevin.
In their first good year, and they said, we got to expand right away, and they either took more space or they moved and got a bigger
space because they're what? What happened? How do you know that? Because the rent has gone up from 2013 $12,000, $199. 2014 $48,000, right? Is that a small jump or big jump? Big jump. So possibly they're expanding too quick, right? Okay, so that's an assumption. So we'll verify that in a second, right? So good. What else? What else is going on?
They have a lot of inventory and a lot of people haven't paid.
Okay, they have a lot of inventory. Where do you see that? On the balance sheet, right?
Yeah.
Now, how can you tell they have a lot of inventory? So from the first year, 2013, yes, which is $223,000 some odd dollars, right? To 2015, $476,000 and $42. A lot of inventory, yes? And also you mentioned that they have a lot of what? Accounts receivables. Okay, from the first year, $121,000 some odd dollars to 2015, almost $300,000 accounts receivable. Does that affect your cash flow, yes or no? Yes. Okay, hell yeah. So a lot of inventory, a lot of accounts receivable. Is that good? No, right? You can see. What else? The what? The cash on hand is dropping. Look, 2013, $34,000. Now, remember I said a balance sheet is a what? A snapshot. So this only tells you what? What's the date? September what? 30th. It's only that snapshot, right? Why are they? So you look at 2015, September 30th, only $2,486. Where did all the cash go? Yeah, and also?
Most of their expenses
have gone up, yes. But a lot of cash is what? Accounts receivable. They have not collect. Right? They have not collect. So is that dangerous? Running a company that's doing $900,000 in revenue, the expense is $445,000. They have $2,000 in cash. That is not very good, right? It's not very good. What else? What else can you see? Good. So far, so good. Good job. Yes. Yes. Okay, not proper maintenance for the inventory and equipment. Where do you see that? So 2014, and you see the, where is it? The repairs and maintenance, right? Okay. So you see 2013, they're spending $3,000 some dollars. 2014, they're not spending anything, right? And then 2015, spending $600 some more dollars. Yeah, amortization is shot up from first year $4,555 to $25,944. Yes. So again, we're assuming if they do better repairs and maintenance, right, you have better cash flow. Does that make sense? Right? So that's a little line. So you look at the two lines and it tells you a story, doesn't it? Yeah? What else do you see? Great job. Great job. Yes, what else do you see? There's a big biggie. There's a biggie here. Come on. What's happening with salaries? Okay, from 100, first year how much? 113,421 to 2015 how much? 200, more than double, right? So the expanding, more inventory, right? More people, but look at what's happening with the gross profit. Okay, it's dropping, right? Okay, the percentage-wise, yes? What else do you see? What else do you see? What do you see? Yes, cost of sales. So they're buying maybe too much, too confident of what they want to do. They're expanding versus maybe instead, maybe it's nice to grow nice and steady. Maybe let's grow sales first. Maybe we don't have every item that the customer wants, but let's reserve more cash. Does that make sense? You see how, is that interesting? You look at these numbers, oh, okay, we're just talking. We look, it's 2 sheets of paper. Have I told you anything about the company? No. Do you know what the hell they sell? No. But you look at this company, I promise you, you look at this, you know an awful lot about their business. Maybe more than the business owner themselves. They don't even know. Actually, you look at that numbers, if you are the owner of this company, how would you be feeling? You'll be very, you would freak out. Yes? Yeah. But if you just, listen, but if you just look at the income statement, and you look at, if you just look at the revenue, inventory, revenue is going up what? Every year. I must be doing a damn good job as a CEO. Okay, I should give myself a pat in the back. Look at how awesome I am. Right? Yeah, even the retained, look at the retained earnings. Look at the retained earnings. Where do you see that? Where do you see that? Yep, retained earnings. 2013, how much? 212, yes. Okay. You're talking about percentage? Where do you see it's going down? It's going up. So retained earnings is going up. What's wrong with that? That's a biggie. Give the mic to Ryan. By the way, let's give Ryan a round of applause because he's the one that put this together to help me out with this exercise. So Ryan is a CA from Pacific Chartered Accountant. So it's not fair. So I asked him not to help out the table because it would not be fair, right? You know. So Ryan, have they pointed out some of the problems that's going on?
Yeah, absolutely.
Now, let me ask you about what about due to shareholder? What's going on there? Yeah, Conor? Yes. What's going on here?
All right, so,
Look at the number, page 2.
yeah, page 2.
Yeah.
So due to shareholder, and like Adam was saying, he said the retained earnings is going up. So he was saying, are they hoarding onto cash? Well, that could be true, but then if you take a flip side and look at this, the shareholder loan is actually going up.
So what does that mean? What does that mean?
He's not getting paid.
Not only he's not getting paid, what does that mean? He's putting in money into the business to keep it floating. So from 2013, $150,000 to then an additional $100,000, right, in the 2 years' time. That is scary.
He actually owns a big chunk if he wanted to exit.
Yeah, he also owns a big
He
chunk.
could actually do a hostile takeover.
To this company?
Yeah.
Okay, so that's a good question. That's a good question. So,
It
so,
is, yeah.
so Ryan, what if, see, look at this. So
Yeah.
professional accounting, right? So what if I wanted, let's say, I'm looking at this company here, and maybe possibly I want to buy it out.
Sure.
What would you advise me?
I would do exactly what you've kind of done right now, is do a vertical and horizontal analysis. So take a look at the percentages, see what's going up, see what's going down. Take a look at a few of the main accounts. So inventory is pointed out, the inventory management is quite bad. In actuality, they're actually losing on profitability, they're losing on their sales, and they're hoarding assets.
Yes.
Which is terrible. He's bleeding money, he's taking on some short-term debt, the due to shareholder loans increasing. You're thinking, well, that's great, the company owes him that much money, but he probably mortgaged his house to put the money in the company in the first place.
Yeah.
So now he's got all this personal debt as well.
Yeah.
You've got accounts payable, which is growing. Big one that actually nobody picked up on was income taxes payable, went up from 33,000.
Wait.
to 5,000.
So income tax payable,
Yeah.
right? Income tax payable,
So income
page
tax
3.
payable.
Yeah.
Page 3, take a look at the income statement. So you see all those income taxes there? Then flip over to page 2 on the balance sheet. It's gone up. They're not even paying their income taxes.
Ah. Uh-huh.
Yeah.
Do you think the Revenue Canada likes that? Okay. So you look at the numbers, you know they're not paying their taxes. So he's bleeding money, have way too much inventory, maybe mortgaging his house, putting into the company, and he's not paying his taxes.
Yeah.
Okay, he's drinking a lot. He's drinking a lot.
Well,
Yes.
the meals entertainment's going to go up for that.
Yes.
So, yeah.
Yes, Sherry?
I have a couple of questions.
Yes,
Okay?
yes.
What does account receivable mean? I know it. What does it mean, generally speaking? But would you explain to me?
Yes, please.
layman?
What does account receivable mean? Yes.
Accounts receivable is basically when you make a sale, like we were talking about with the 50% down and 50% you have still yet to receive, it's basically your sales you haven't received in physical cash yet. So you notice his sales is going up, looks great, like Dan was saying, it's gone up to 900,000, but at the same time his AR is also going up just as much. He's actually not collecting on physical cash, which is bad because some of that you may never actually even collect on, and that's called bad debts. And they want to make sure you have a good collections department.
Mm-hmm.
What does share capital mean?
Share capital, yes.
Absolutely, share capital. So this is gonna be a little different because this is a private company. This is we tailored this to look like something that you guys would look at for your own financial statements. Share capital, that's $12. That's the value of your shares that you purchased when you started your company.
Yeah.
Public, when it goes public?
Well, this is
No,
a
no,
private. This
private,
is a
it's a
private company.
private, yeah.
Public companies when you list on the stock exchange. Until most of you guys do an IPO, you're gonna be private.
Okay, I don't understand what share capital means. Sorry.
So share capital is the value of your shares. So when you incorporate your company, you have to have shares in your company.
You have to give it a value, right?
Yeah.
And how many shares you're going to issue, right?
Yeah, you can have 100 shares, 10 shares, whatever, but they have a value when you bought into them.
It could be $1 share, it could
Yeah,
be $10 a share.
10 cents, whatever.
What does retained earnings mean?
Yeah, we take
Yeah,
it.
so retained earnings, absolutely. Retained earnings, think of it this way. They are the earnings that are retained in your company that you have not pulled out yet.
They have not poured out. So this money they're supposed to have been made,
Exactly.
but they have not poured out. So again, this is a snapshot. It's not a fact, right? So they have made that money because there's a lot of accounts receivable, right?
Exactly. There's a lot of accounts receivable and some of that.
yeah, but they have not collected the money put in the pocket yet.
Yeah.
So does retained earnings mean the account receivables? I'm not very clear.
No,
about
no, it's absolutely fine. Retained earnings is pretty much,
Give an example.
in theory,
Yeah.
the cash that you haven't pulled out of your company, if you will. It's your assets, so everything you have, like Dan was saying
You
on
own,
that drawing,
yeah.
that you own,
Mm-hmm.
minus your liabilities, so the amount that you owe somebody
yeah.
else. that is what you have inside your
That you
company.
could go out.
That could go out. Now, in this case, and I don't know if it's pointed out, some of those retained earnings are actually made up of the debt that he's taken on or she's taken on in their company.
Yeah.
So it's not all clean, like free cash flow.
Mm-hmm.
And I noticed Dan took out the cash flow statement because that had a lot of the that would have given a lot of the answers away.
Mhm.
But if you took a look at that, the free cash flow was actually going down. It was dropping. It was actually getting pretty bad.
Okay, so hold on a second. So you can see that's a good conversation that you could have if this is your company, right? To have with the accountant. Can you see that? Yeah, there's no such thing as a stupid question. You get it?
No, absolutely. Ask away.
I know I'm stupid, but I'd like to learn and
Exactly.
be stupid myself.
Exactly. So what does that exactly? What does that mean? Like, even it's so obvious, account receivable, right? But what does that mean? Okay, now I see, right? Sherry, yes. One more question.
So this comes to a question I have around so many people who've gone down in business. and
Yes.
Said, oh, I had a shady accountant.
Yeah.
Is it because they weren't monitoring this and watching this and knowing what was going on?
Good question.
No, it is a good question.
I'll let Ryan answer that.
Okay, keeping it very simple, very short,
Yes.
not take too much of Dan's time. A lot of people say they're accountants. Doesn't mean they're actually qualified at what they do. And there's different kinds of accountants. So I'm a chartered accountant. I guess we're chartered professional accountants now. It took me 7 years to become a CA. So we're more than just bookkeepers. When somebody talks about a shady accountant, it depends. They're about their code of ethics. Depends about how good we're able to talk and ask questions. I sit down and talk with clients all the time. We're never billing them. We never take on nickel and dime clients. It's about the value that you get. So if you ask your accountant questions, so all you should have accountants. If you have your accountants, if you ask them these hard questions, they should be able to explain them to you. If your accountant cannot explain your own financial statements to you, you probably have a problem.
Oh, they say to you, don't worry about it.
No,
don't worry about it.
They will. Either they'll say you don't need to worry about it,
Yeah, don't need to
or
worry
we'll
about
talk to you about it later. And you'll be surprised how many accountants actually say that or bookkeepers say that.
Yeah.
It's because they don't know.
Yes, one more question.
Protecting the accountants of Canada, that are all, like a bar and a lawyer, people will blame the accountant because they don't understand numbers that they've been
Yeah.
presented to them.
Absolutely.
Yeah. Yes, one more question.
Absolutely.
Two more. I have never seen an audited balance sheet. Why? And everything has to declare this according to the standards of Canadian accountants. And this at the very beginning says that.
Yeah.
How would I trust this and a non-audited?
Yeah, what's the difference between audited financials and
Absolutely. So
unaudited
audit financials, the first one is you pay a lot more for audited financials.
Yeah.
The reason why is a bank, let's say you have a loan, okay, the bank's gonna wanna have assurance that the numbers you have on here, exactly like you point out, are real.
Yeah.
So the accountant will go in and set an audit team and you'll hire a
And
third
check
party.
out, yeah.
And they will actually go through and check everything out and make sure those numbers are real. These are unaudited statements, which probably the majority of the people in the room will have,
Mhm.
and that's because your bank's not gonna require audited statements. There's no need to have one. That being said, if you have a good accountant, they will check through, ask questions, is it reasonable that these numbers exist, and go from there. But it's usually quite expensive to have an audit.
Yeah.
And, yeah.
This is a quite very homogeneous kind of financial statement, meaning that it was very numbers, it's very obvious.
Mhm.
What indicators? Give me three indicators that
Okay.
see if I see ups and downs, and numbers, something going up, inventory up, I don't know.
Okay, that's a good
Down.
question, but hold on to that.
Okay.
Hold on to that. So round of applause for Ryan. Hold on, it's a good question. Because we talk about the cockpit. There are three important dials. What are they? What are they? What's the first one? Balance sheet. What's the second one? What's the third one? Okay, now pass out the cash flow statement. I want you to see the cash flow statement. See if you get a different story. Yep. And I'll give you very quickly, I'll give you 3 minutes to go through that. Look at the cash flow statement, just 3 minutes. And discuss among your table. What is going on? Some of you will be like, oh. Just one piece of paper. One additional piece of paper. What does that mean? Look at the cash flow statement. Thank you. Thank you, Mike.
At least this is a made-up company.
Yeah, made-up company. But a lot of companies are like that. Don't be surprised. Don't be surprised. I like it. I like it. Now, Chris, you're getting it, right? Right? Give your neighbor a high five and say, holy smoke. Now, let me ask you a question. Now, looking at the cash flow statement, do you get a better understanding exactly what's going on? Yes or no? What is this telling you? What is it? Sinking ship. Titanic, yes. Bad news, yes. Now, when you look, listen. Sell. Nobody wants to buy this shit.
Numbers are in brackets. That's like negative.
Negative.
Yeah.
It means it's negative. So you look at a balance sheet and you look at income statement. You thought it was pretty bad, right? When you look at this, what does that tell you? It's really bad. It's like you thought it's pretty. This is really bad. Okay. Ryan? How close are they from losing their company?
I'd say maybe less than 6 months.
6 months. And the owner goes to work and talks to all the employees. Hey, how's it going? Revenue's good. Good job, guys. Right? Employees have no idea. In a few months, they'll be out of job. Not just out of job, because how much money he's owing. Okay? This would wipe him out. This would wipe him out. All because he doesn't read his financials. I want you to get how serious this is. I want you to see, not just, we're having fun, we're looking at numbers, right? But look at the numbers. For some of you, if you don't look at the numbers, from now on, are you going to have a cash flow statement, yes or no? Yes. Hell yeah. How often you review it? Once a year? At least quarterly, right? At least quarterly. You look at what is going on here. Ask questions. Make some changes. What else have you learned? What have you learned? What's going on with the numbers? What's the most scary aspect of this thing? Cash at end of year? Yeah. Yeah, cash end of year.
The cash paid to the suppliers and employees.
Yeah, cash paid to suppliers and employees. So is it possible? I don't know, because we have to find a little bit. But is it maybe a good idea maybe to lay off some of the people that he has? Right? Maybe get rid of some of the inventories that's not being, maybe the dead inventory not selling well. Get some cash coming in, right? So, but if you don't know the numbers, how do you know those are the right decisions? Right? The strategies and tactics. He could have just said, you know what, I think we need to do another Facebook campaign. Is that his problem? No. But he might think, that's my problem, man. I need more sales. I just need to sell more stuff. Dude, your problem is not sales. It's accounts receivable. It's inventory, right? It's repairs and management. It's employee. Your overhead is too high. Now, the good news is those things actually can be fixed relatively in a short period of time. Okay, you can do a blowout sale, lay off people. It actually doesn't take as long as you might think. Make sense? Yeah? Okay. So far, so good? Yes, Kevin? Yes? Yes.
It doesn't matter what industry you're in. This doesn't talk about product.
Yep. It doesn't matter what industry you're in.
Like, oh, no, I'm in a unique business, this doesn't affect me. This doesn't matter what you do.
Yes.
Like, it'll affect you.
Yep. It would affect you. Again, facts don't cease to exist just because you choose to ignore them, right?
Yeah.
Now, yes, one more question. I got to keep going. Yes.
I was wondering, because different businesses have different requirements for that.
Yes.
Does anyone know if there's any site for sector-specific businesses to go over some of these?
Oh, okay. I think the question is, let's say, depends on I'm in a manufacturing business. What would be a good industry standard? What is a typical, profit margin? Am I within that range, or am I not? Is there a site? Is there something like that?
Well, you need benchmarking with your accountant at the end of the year if they're a good accountant, right?
Yeah.
So
You-
as far as the website, let's say, I'm a coach, so a lot of this would not be applicable at all.
Yes. So in a service-based business as a coach.
Yeah, so
Website that lists in this certain kind of business, here's some of the numbers you should be looking at.
again, it's going to come down to benchmarks. Unfortunately, Stats Canada was 3 years behind. I know they're not always the best. You want to try to benchmark, and unless you can take a look at public companies, and even then, that's not going to be really a great way to benchmark because you're
Mhm.
mostly privately held. The best way is to sit down at the end of the year, really go over your financials with your accountant, and if they're really in tune with your business, they still go through and nail all those questions that you have.
And
And don't be afraid to ask
Yeah.
all those questions.
and also a lot of this is highly personal.
Yeah.
Right? It's like what is too much risk, what's not enough risk, what kind of profit margin you are looking for, how many hours you put in the business, how much money you want to actually take home, right? So some people say, as a coach, if I make $50,000 a year, I'm quite happy. Some coaches, I want to make at least $250,000 take home in my pocket. Well, so what is your goal, right? Does that make sense? So I've got, this so far so good. It's taking a bit of time, but we have to go through this, yes? Yeah, so I'm going to go through some strategies. I'm a little bit behind, so I'm going to go a little bit faster. Is that okay? Yeah, because I still have a lot of profit maximizers I want to share with you.
10 times your finances, 10 times your business, 10 times your marketing, 10 times your life. Hit the subscribe button now.